Air Products and Chemicals delivered a mixed Q3 2026 report today, beating consensus on the bottom line, but missing slightly on the top line. Adjusted EPS came in at $3.47, which beat the $3.34 consensus. Revenue hit $3.16 billion, missing the $3.27 billion estimate, even though it grew 4.6% year over year.
Right, and management actually confidently raised full-year FY26 adjusted EPS guidance to a range of $13.39 to $13.49, plus they set Q4 guidance to $3.55 to $3.65.
So shares initially surged 3.65% in pre-market trading, but then they quickly reversed into a decline once the market digested a staggering gap loss hidden right beneath those adjusted figures.
Yeah, that's the typical earnings whiplash. Because when you pivot from the adjusted EPS beat to the actual gap performance dragging it down, it is brutal. They took a massive $2.9 billion pre-tax charge.
Oh, $2.9 billion.
Yeah, which triggered a gap loss of $6.47 per share and a $2.1 billion operating loss.
A $2.9 billion charge is just, that's a staggering write-off for a single quarter. And they're slashing full-year CapEx to about $3.5 billion, meaning they're completely abandoning a major piece of their pipeline.
Exactly. Management is outright abandoning major clean energy initiatives. We were talking about the Louisiana Clean Energy Complex and an Arizona liquid hydrogen facility.
Wait, just walking away entirely?
Completely. These were highly speculative bets on green energy, and by halting them, they have to write down all those sunk costs. That is exactly where that $2.9 billion hit comes from.
It really sounds like ripping off an incredibly expensive Band-Aid to stop the bleeding. Like they are forcing a hard pivot back to the company's traditional industrial gas routes.
Right. It is pure capital discipline, taking the pain today to reallocate resources away from speculative tech and back into the core business.
Okay, but since APD is retreating to its core business, we have to ask if that core is actually strong enough to carry the company forward.
Well, the segment performance suggests it might be. Overall, operating margins expanded over 100 basis points to 25.6%. In the Americas, sales hit $1.3 billion, which is up 5%.
And Asia sales reached $886 million, so up 9%. Looking at the data, the core is being propped up by a massive $3 billion traditional backlog, right?
Yeah, and over half of that, like $1.5 billion, is in electronics project wins fueled by the semiconductor supercycle.
Oh, got it.
They are locking in agreements for air separation units for new chip fab plants. These are immediate, high-margin needs, not speculative bets.
But hold on, is that semiconductor tailwind robust enough? Because I'm looking at the notable risks flagged in the report, and they specifically call out falling helium prices and macroeconomic weakness across Europe and Asia.
That's a huge tension you have to watch. Helium is facing a structural headwind from oversupply, bringing prices down.
Right.
And if Europe or Asia slows down further, industrial gas volumes will shrink. The semi-cycle is a great tailwind, but it's famously cyclical. If it cools off before the broader macro environment recovers, maintaining those 25.6% margins is going to be tough.
For sure. Now, for income-focused retail investors holding through this mess, they did maintain the $1.81 per share quarterly dividend.
Yeah, which is roughly a 2.4% yield, so you basically get paid to wait out the turnaround.
Exactly. So, leaving you with a final thought to mull over, does APD's sudden costly exit from domestic clean energy projects represent a permanent surrender in the green hydrogen race? Or is this merely a strategic retreat while they wait for the market to mature? Follow the show for your daily earnings coverage, and we will catch you next time.